Ladies and gentlemen, welcome to the SoFi Weekly. For the second show in a row today, it is not me who's late, okay? This time I said I'm starting it anyways. Tevis will be here very shortly, though. He's just resetting his computer.
He's pulling a Tanner.
Yeah. So I got a lot of bricks around me. What?
Great.
Roy, check your mic, by the way. I think it's coming out of somewhere else. It doesn't sound very clear.
Can you hear me now?
It's very robotic, almost.
We can hear you, but it sounds like it's not your normal mic or something. Yeah. There you go.
How you doing, Chris?
I'm good.
Thanks for joining us on the SoFi Weekly today on a week that really was not too spectacular.
Not for the stock.
Yeah, not much news, I guess.
Am I good now?
Yeah, you're great.
Yeah, that sounds better.
I'm supposed to be bottom right, and then Chris is top left.
Like that?
Top left.
Everybody has bricks tonight. That's great.
My bad.
Mine are real, though.
This is how we bootleg Tanner again. We're revolting. Everybody has bricks.
Yeah.
Steve.
Yeah, and Steve. So, ladies and gentlemen, this week was a very emotional roller coaster in a way for SoFi stockholders. We saw the largest stock drop this week. If I'm not mistaken, that was on Monday? Tuesday, over 50.
It started to sell off on Monday for what was apparently no reason. And then Tuesday, it really dropped off.
Yeah, and so we're going to talk about a little bit of that. I brought Chris on to help with some of the particulars. Now, he is also going to state none of us are, investment bankers or fully understand what we're talking about. We're really on the shoulders of giants that have helped us through understanding what has gone on this week. Chris, actually, maybe I can bring up your tweet, showed off probably the three main people who really helped us out. So if you guys want to give them the follow on X, let me bring up that tweet really quick. But Chris, although being a chemical engineer, is a very fast learner, picked this up very quickly, and an absolute wealth of knowledge that had to be on this show today as we go through one of the more complex deals that I've seen while being a SoFi shareholder. So, Chris.
Yeah, it's definitely the most complex deal. I think I don't think I've ever invested in a company and remember a deal. Well, I guess I've invested in a lot of companies and I've never followed them quite as much as I do SoFi, right? But there's lots of true. there's lots going on here. I don't know even where. I guess we'll start with the high level. What happened, and try to do facts-based stuff, and then we'll kind of move into more kind of analysis and thoughts. So on Tuesday, SoFi released a press release in an 8K that said that they were kind of doing two. They called them separate transactions. So the first transaction, or the first transaction, was they were offering, at the time, it said $750 million in senior convertible notes. And then the second transaction was that they were retiring $600 million of a previous senior convertible note deal. So we'll handle these kind of one at a time. Chime in if I get something wrong or if I miss something. But the idea is, so we'll start with the $750 million of convertible notes, which turned out to end up being $862.5 million because they ended up being oversubscribed. But the idea behind a senior convertible note is it's a way that you can fund your company. So you take out debt. So you go to the markets and you say, hey, we want to take out a $750 million loan. And they say, okay, here's the loan, here's the $750 million, and they're convertible notes because that $750 million in debt can be converted into SoFi stock at some time in the future. And we'll kind of discuss the details probably as we go through here.
Yeah.
But the idea is that you could, so it's debt now, and it's got an interest rate, and the interest rate is 1.25%, which is super duper low in the current market, right? And
For good reason.
but then those, for good reason. So at some point in the future, they can convert that $750 million into $750 million worth of shares. And so that's what the convertible note is in a nutshell. And then at the same time, they have this old debt that was going to come due in 2026, and they issued $61 million approximately. We actually don't know the final number yet. It's still undetermined. But approximately 61 million shares they have to issue in order to pay off $600 million in their previous convertible notes. So it's these two transactions that are, I think, probably related, even though they are separate transactions. So
Now,
I guess we can start from there.
Yeah. So the first one is, in my opinion, not too hard to understand, or at least for me to understand, is the fact that they went in to potentially all the way till 2029 to get really cheap debt, 1.25%, at least until they turn that into shares. But for now, 1.25%. And they are replacing a lot of their really high interest debt, like, the preferred shares that they were paying out 12.5%. Can you remind me, Chris, what is the amount that it's going to be rising to? Because I've heard a bunch of different numbers.
17.5. I have it up.
So.
I have it.
So it's not, if you look at the 10K, it's not 17.5. So the 17.5 number has been floated from a couple of different sources. If you pull up the actual 10K, what it says is that so I guess they have $325 million worth of preferred shares. And those preferred shares get a special dividend that for the last 5 years has been 12.5%. So if you convert that, you take 325 million and you multiply it by 12.5%, it ends up being just over $40 million. So just over $40 million a year, they're paying in a dividend to these shareholders. In May, that number comes down to, or that number gets updated, and it gets updated. If the 10K is right, what it says is that it's the term SOFR rate, which I didn't even know what that was before I invested in SoFi. But basically what it is it's just it's a benchmark rate. So it's some benchmark rate, and then you add, it's like 9.95% onto that. And that benchmark rate today is like 5.3%. So if the terms in the 10K are accurate, what it means is that starting in May, or at the end of May, that 12.5% would increase to like 15.5%. And so that bill that would come due would increase by another $10 million every single year. And so what they're doing with these convertible notes is they're paying them off. So they're paying off those shares. So they're taking $325 million of that convertible note that they're borrowing, and they're using it to pay off this higher interest debt. So basically they're saving, call it $50 million a year in interest, and exchanging it for paying something on the order of $10 million a year. So they're going to be saving $40 million a year in interest payments.
Here's my question, I guess, for the panel. Was this $40 million a year in their guidance, or is this something that we have to now add on top of it as because so the full year guidance for 2024 was between 95 and 105 that they provided at the beginning of the year. They're going to raise that guidance multiple times throughout this year, most likely, just given their previous history of having raised it. But 95 million to 105 million in net income. Now, SoFi, by paying off this $325 million high interest loan, they are saving 40 million. Is it actually going to be 40 million? It's 40 million minus the 1.25 prorated per year. So maybe a little bit less.
It'll end up being about 40 million because it's going to be escalating to 15.5 or whatever million, or 15.5% later.
So regardless,
that's only for the preferred shares. They're also lowering other debts as well, which we don't know the exact numbers on that, but
I would guess. So if you take a look at their stuff, and if they're actually going to use it to pay down other debt, I would think that they would actually use it to pay down their revolver. So they've got a revolving credit facility that's also on some variable rate, and I think it's like 7 or 8% right now. So like that
Gotcha.
would probably be what I would guess, but I don't know, right? Like that's purely speculation.
Yeah, I don't think that this would be in the guidance at all. The guidance was soft, but in a typical SoFi way. It just a lot of conservative assumptions, not, very much slowed growth rate. And I know on the lending side it makes sense, but with the other sides, it just doesn't. So I don't think it's in the guidance at all. Could be wrong. If I'm wrong, then I think that it's an epic level of sandbagging, not just the typical sandbagging, but we'll find out.
Well, if it's not in the guidance, then like these guys can print 150 million in net income, like for this year. I mean, 100 was the top range. If they're going to add another 40 million onto that, let's just assume, to be super conservative, that 10 million is their sandbag quota. Like 150 plus, I feel like is so achievable if it's not in the guidance. But
so,
yeah,
I'm going back and forth on this because I'm hearing some people, I guess I could say Brad Freeman, who said that this potentially was in the guide because they said that they expect, or it includes expected capital market transactions, like this one, for example. So I don't know if this does fall under the guide, but yet whenever they did make the guide, there's no way that this specific deal would have been set in stone. I mean, it just finished up, right? So who knows? But maybe potentially they knew one way or another that they were going to be restructuring their debt, and maybe they knew approximately where, they were going to be able to get a good rate. But who knows?
One other thing that may make it, I go both ways. I can see how they wouldn't guide on something that's not finalized because it's not finalized, right? Like, and you don't want to put that into your guidance. But on the other hand,
That's
and
what guidance
actually,
is.
yeah, exactly. But on the other hand, and one of the Compass Point analyst actually pointed this out in one of his notes, is he said, if you look at the guidance that SoFi gave, it actually doesn't add up unless they do some sort of unless they enter capital markets and either pay off their preferred shares or do something else to change things around, because they guided for this 95 to 105 million dollars in what they call net income, but then their guidance for EPS for the year was only 7 to 8 cents.
Yeah.
And so if you assumed that and the way that SoFi does their numbers, the 95 to 105 million would not include that $40 million plus of dividend. And so it should have been, if their net income was 95 to 105 and it didn't include the dividend, then the equivalent EPS should have been like 5 to 6 cents, but instead it was 7 to 8 cents. And if you kind of take the numbers into account after the fact, then it ends up equaling out. So again, I could go both ways. I don't know whether it was in the guide. I don't know to what extent it was in the guide. I doubt it was in the revenue guide, kind of like Roy said, because it would be really sandbagging, because so the deal from a high level actually makes it so that they no longer have to pull back on lending like they were going to, which I'm sure we'll get into as well. So I don't know. I go back and forth onto whether I believe it was or was not in the guide.
The big factor for me too, and you guys have been in SoFi longer than I have. I was tracking it before I invested last May, but not at the detail that you guys were. This is a very conservative company when it comes to guidance, and I don't remember any time when they have guided for anything that wasn't just like 100% sure. And when it's sure, they hammer it. So the Q4 profitability, they again and again went back to that. But as far as everything else, like, it was just a positive surprise. Wow, another triple beat. Surprise, surprise.
Well, it's hard to say that they're guiding for like something that's guaranteed. I mean, they said something like 2.3 million members this year. Like, how can they guarantee that?
Nothing's guaranteed, but that's very likely.
No, it's very likely. I completely agree. But I just think in the idea of an outlook or guidance is based on assumptions, right?
Yeah, but you're talking about a company who has in their baked in assumptions the fact that we're going to be like in a heavy recession by the end of the year. Like, it could very well not be in the guidance given how conservative they are. Like, even if there was a slight chance of this thing not closing, or if the numbers being materially different from what they thought they were, like, they could have had foresight on the deal, but not the specifics of the deal. And even that alone, just with their conservative nature, could have led to this not being accounted for because they don't know all the details.
Sure. Yeah.
And due to where we're falling in the quarter, I'm guessing as far as the actual quarter one results, we won't really know. But the quarter two guide, I would think that they would guide either, they'd revise it dramatically if this wasn't in the guidance, or if not, then we already know that it's baked in. Is that what you guys are thinking?
Say that one more time.
So where we're falling, this is in March 8th, and this isn't, finalized yet. So whenever it's finalized, that'll likely be quarter two or by quarter two. So we're not going to see it in the actual numbers that are produced for quarter one.
It is,
but
it is finalized as of today. They released an 8K. It's like
48
pages.
Yeah. Okay, awesome. So we're not going to see much of it as far as in terms of revenue in quarter one, but as a guide for the next quarter, and they revise that upwards, I think that we'll be able to tell based on how they revise a quarter two whether or not this was actually baked in. Is that what you guys would assume?
Yeah, I mean, especially with what I think the big change in any potential, margin for these changes for the preferred shares, they're paid out from what I understand on a quarterly basis. So we don't know where that falls, but I'm going to make a bet that doesn't fall between March 9th and March 31st. So who knows? But I don't think it's going to affect Q1.
Regardless, to answer for your question, Roy, for Q2, they're going to raise their EPS either way. Like, if this reflects or if it doesn't reflect, they're just going to raise it either way. So it's going to be, we're going to know though, like if they come into Q2 and they report like 3 cents EPS or 4 cents EPS, it's going to be a pretty educated guess to say, well, probably they're not going to hit 7 or 8 by the end of the year. They're going to hit like 10 or 12 or whatever it may be.
And one thing, I guess, kind of on the guidance thing, I think the bigger deal, at least when I look at this deal, is so I guess we should probably talk about the ramifications of the deal for the actual company, right? So why did they do this deal? So number one was to pay off those preferred shares. So basically, like Tanner made a good point on this on one of his videos where he basically said, so SoFi is taking a page out of their own book and they're refinancing higher cost debt for lower cost debt, right? So that number one helps them, right? That's $40 million less that they have to pay every single year when you're switching out the higher interest free fee for the lower one. The other thing that this really does for the company that helps them out is it helps on their capital ratios, which means that, so SoFi, it's a bank, it can only loan a certain amount of the capital that it has on the books. And they are being very conservative right now. And then the last quarter, they actually increased the capital ratio. So the very bare minimum they could ever get down to is 10.5%, but you never even want to get close to that, right? And they guided in the last quarter, they said, we're going to stay above 14%. They said, we'll end the year above 14%. And they talked about how they're going to stay the whole year above 14%. And they were at 15.3%. In the press release that came out with this deal, they said, if we would have done this in Q4, it would have given us at least 2% increase to that. So instead of being at 15.3%, we go up to 17.3%. Now, that's a lot of jargon and mumbo jumbo. What does that actually mean for the company? It means that they can now continue to grow their loan book every single quarter this year by about $2 billion, which is last year when they were really ramping up originations really fast and they didn't have as much principal coming off the books because they didn't have as many loans from previous. They were growing their loan book by about $2.5 billion. Every single quarter. So that means, and they're also, now they've got this forward flow agreement that's $500 million a year, or sorry, $500 million a quarter. So basically what this means to me is SoFi can continue to grow their loan book now, and lending, I don't know how it would make sense for it to go down to say 92% of what it was in 2023 if now they can continue to grow their loan book. Now they may take a really conservative stance still and maybe not grow it as much as they did last year, but I can't see an environment where they would just have done this whole deal to free up that capital ratio space and then not take advantage of it somehow.
Yeah.
The other possibility that was in my mind is, and I think Tevis was the one that mentioned this a couple of months ago, correct me if wrong, is that they may be gearing up for an acquisition. I don't know that they will, but this is a company that has a history of doing that and doing that well. I I think I'd prefer to see the loan book grow, but I mean, it depends what they're buying.
So from what I heard, just to because I know a lot of
Somebody
people
hates my voice. They say
Yeah,
it's
I
so
read-
annoying. I apologize for my voice.
So a couple things. One, if you guys want to understand just how important those capital ratios are going up, go back and listen to the SoFi Weekly, listening to the earnings call whenever Chris Lapointe actually said that the capital ratios went from 14.5 to 15.3, and look at our faces whenever that was announced. It's a bunch of like it was the best news out of the entire earnings call, is that, you know, they were actually able to sell a large percentage of their loans. You know, Chris and I had a pretty good debate going back and forth on if SoFi is going to hit a brick wall. The ramifications of an extra 2% is massive whenever we were talking about just being roughly 4% away from, you know, regulators coming in to put a full stop to the party. So yeah, it's definitely important. I think another thing that's important for people whenever they first saw this come in, this convertible note, versus what people need to understand, is that it's not like SoFi needed to raise capital. They were doing perfectly fine. They probably would have been perfectly fine even with those high interest rates. It just is not as sexy as potentially it is now.
So hold on, like pause right there, because I think that's one of the things that I wanted to chat about, because that folds into the conversation of why now. I understand why now with regards to the 5-year term that can be redeemed in May, like to offset that 12.5% interest. What I don't understand, and I just don't get it, is the second part of this deal, where they issued 61.7 million shares to retire $600 million of debt.
Yeah, but you're skipping way ahead.
They issued it together in one press release, right?
Yeah, but I don't know how that went into what I was saying, but yes, there was a much more complicated version. I'm actually getting fatigue because I feel like the opinions of people are changing constantly. It's like health fatigue, where they tell you, like, you know, yolk is healthy, no, yolk is not healthy. Like going back and forth. Is it dilutive or not? I mean, that's the real answer. Or question, sorry.
Right. Dilution is a big topic. So yes and no and maybe, and it all depends on capped calls. And I've spent way too much time this week learning about all this stuff, and I still don't get it. At least not completely. So I guess there's two parts. Again, the $61 million or 61 million shares they have to issue to pay off the $600 million in loans, that is dilutive, right? So those are outstanding shares that they're going to add to the float in order to pay off that 600 million. And I put this out on Tuesday itself after I went through and reviewed everything. If they could have done just the convertible note deal, the new convertible note deal, without issuing those shares to pay off the old convertible notes,
right,
like that would have been a slam dunk. It would have been awesome. I have a feeling, even though they were separate transactions, that they were still somehow not completely independent, right? Like I would guess that there is some sort of linkage on the business side between the people who are holding $1.1 billion of convertible notes previously and the ones who are going to be investing in $750 million in convertible notes on the exact same stock later on. I don't know that for sure. That's speculation. But my guess is that they're probably linked somehow.
So the thing that
go ahead.
Yeah. Well, so the thing that I logically don't understand with regards to that is that 600 million in debt had zero interest. And so you're diluting shareholders by issuing new shares to pay off something that has zero interest rate right now. Meanwhile, like at the very, and I get it could have been out of their hand. And I'm curious to get your thoughts of like whether this was out of their hand. These institutions were like, you know, pay us back basically. Their hand was forced. But let's say even if they didn't want to tap into their cash to pay off the 600 million, why wouldn't they just make the 2029 convertible notes like a $1.2 billion offering and then use those proceeds to pay off the 600 million instead of issuing shares today? So I guess there's a couple of parts, right? Like number one, why would they pay off something? Why would they issue more shares today to pay off something that has 0% interest? Like, it has no utility. And number two, if they have to pay it off and their hands are tied, why not just increase the convertible notes for 2029?
So I just really quick, it wasn't actually like it wasn't a free loan. It's rounded down to zero. So it's important to know that it wasn't just like, we got free capital or something like that. It was like 0.43% or something like that, which is still low, but we replaced it with a 1.25. Like the both convertible notes that we've had have been extremely low interest rates, but they are going to eventually turn to equity.
So part of the reason also is the capital ratio discussion that we just had. A lot of that capital ratio being freed up is the fact that we're retiring these old notes at 600 million, and we're using equity to do that. So that's what's freeing up the capital. It's not necessarily the 700. The new convertible note deal doesn't really help us with our capital ratio as much. And the other thing that the other thing that we should mention is they're actually buying back the $600 million of principal at a discount. So they're buying them back for about $530 million worth of cash. And so that actually helps us. So that's net income that helps the company. So it's like it drops to the bottom line. And it also helps, again, because we're paying it with equity rather than issuing new debt. That's what is freeing up most of the capital, is my understanding.
Right.
Yeah.
Sorry, I think I cut Roy off.
I get that whole 89 cents on the dollar. I just don't understand why they felt the need to do it now.
Yeah, it's an opportune time to issue more loans, and the capital constraint piece was, one of the key bear arguments 5-6 months ago that was just being hammered like in the news every single day. It felt like so, but yeah, I agree with you as far as those that conversion. Unless they're decently aggressive on the loan side, or they have an acquisition lined up, or they're seeing something in the macro that just looks terrible in the short term, which I don't see. I don't think that's happening. So if we actually come in and we have lending revenues reduced throughout the year, that they're not actually aggressive, they don't do something with this, I'll go from saying, yeah, this is a good deal overall, to absolutely hating it just because of what you said, Thomas. But if they use the money effectively, it's going to be worth it. Ultimately, for me, it's I've seen this management execute consistently over the years. And they're phenomenal. And so they have something up their sleeve. We don't know for sure what. Maybe you guys have a better guess than me, but I think they're just going to be aggressive with the loan book there.
Well, I think Chris might have nailed it, actually. Like, if it was the same institutions, just thinking out loud about this, the 2026 convertible notes had, I think, a $22 conversion price on them. And those were made back in the 2019,
2021.
Yeah. So they were never going to hit the 22 price target by 2026. I mean, it's a more of a reach. So if it were those same institutions, they could have probably rolled over to the 2029s, which would have forced SoFi to pay one for the other. I guess that could be an explanation, but other than that, I just don't see it for that part of the deal. I think that 750 and the capped calls, which, I mean, we can talk about, I think that's super smart for a lot of different reasons. It's just the 61 million shares I don't understand.
I just think that they were linked. Like, I think at the end of the day, they wanted to pay off the preferred shares. They wanted to refinance some of their old debt. And when they were going through, like, you can't get something for nothing, right? Like, there's always another person on the other side. So it's not just SoFi who's negotiating. It's also the people who own these this debt that's underwater for 2026. And they want to be able to recoup some of their losses and other costs, right? They've also been holding these notes since 2021. Interest rates have gone way up. The price of this debt has gone down, right? SoFi was able to buy it back for 89 cents on the dollar. And not only that, they are losing, it's $1.1 billion worth of debt that they issued, or capital that they issued, and they're getting 0.43% interest. They could have that in treasuries and be getting 5.5% interest, right? And so, like, there's two sides to this deal. So this is my personal opinion. Again, in none of the public filings does it say these two are two sides of the same coin. But my read here is that the fact that it happened at literally the identical same time, that the 8Ks were linked every single time, that even the 138 page like description of the deal has both of those deals in a single press release in a single 8K. It just seems like that it doesn't seem like a coincidence that these deals happen at the same time.
There were a couple people talking about, or maybe it was one person, I don't, anyway, that the capital ratios potentially wouldn't have actually raised up to 17.3% without both of those deals going through, that one would actually lower it and the other one would raise it up. So yeah, it's incredibly complex, and I haven't even had a lot of time to go through some of the really complex parts. The parts that I want to talk about, however, and I really need some help understanding, is the capped call part of this transaction, right? The understanding that, is this actually going to stop the dilution, or is it only to minimize it, and it's actually dependent on where the stock price falls? So
the second one, Tevis, do you want to start?
Okay. Yeah, sure. Okay, so I can set the stage for this. So the 750 that they, or I guess 862 that they got from this deal, about half of that went to the 12.5% interest. The other half, 346 million or so, general corporate purposes and retiring additional debt. And then about 78.8 million went to capped calls. And the reason for this was to offset dilution. Now, to answer your question, Tanner, just before I go into the call option side of things, they could have adjusted that amount to buy more or buy less. So I think that they have structured it in such a way where if they hit a certain point, they fully offset that dilution. Otherwise, why wouldn't they just buy more of those underlying options to fully offset it? Like, why would they only buy 78.8 million and offset, let's say, 50% if they hit? So I do think that management is aiming to offset the entire amount of the dilution, because there's like another 346 million that they're using for general corporate purposes, i.e. like, we're just going to keep it. So the capped calls, I think a lot of people got confused at the capped portion. We can leave that for the end. It's just the call option that they're buying on their underlying stock, so that when the stock hits a certain point, i.e. the point of conversion, I think the note holders can't convert the stock until it's 30% higher than the point of conversion. So 954 was the conversion point. I think 1228 or something like that is the point at which the note holders can say, okay, we're 30% above conversion point. Here's our notes. Give us the underlying shares. The capped call portion, the strike price, I believe, is 954, which is the conversion point, at which point SoFi would essentially be making a gain on their call options. And when the note holders want to come and redeem their shares, SoFi sells those call options. They can get the underlying shares from the market, from the broker, essentially. And as a result of that, they wouldn't have to issue new shares to create new shares out of thin air and cut everybody's slice of the pie a little bit thinner, because they have this arrangement. Now, the cap is simply protection. This is how I understood it. Then we can have a chat. But the cap is 2x what the stock price was at closing. So it was 724, and I think the cap is 1454, something like that. So at which point, if SoFi hits $14.54, there's no more upside, because if the broker is the one that's writing these call options, they have to cover themselves on the back end, right? They're not going to like write call options and then just see if SoFi hits or not. And if they hit, they're going to buy the shares on the open market. They're going to write them. They're going to buy the shares on the open market. They're going to hold those shares at a cheaper price. And then when it hits, that they have the shares to pay out. And so if they had no cap, then essentially that's unlimited downside for the broker, unlimited upside for SoFi. That's how I understood it, at least. So the broker would not do that deal without a cap. And again, SoFi doesn't necessarily, they're not gambling their company money on their underlying stock. They just want to hit a certain amount so that they can offset that dilution. So it works both ways. And yeah, that's how. So essentially, if the stock hits a certain price, what happens is the note holders are going to say, okay, we want our underlying shares. We want to convert. And SoFi is going to sell those options, get the underlying shares from the market, give them to the note holders.
Roy?
I came away with somewhat of a different understanding. The piece that you're absolutely right on is the lack of dilution. The calls are not, or the call options are not going to just have shares printed out of nowhere. Someone is hedging against that. If the market maker, for some reason, and they won't do a total hedge on all the shares. I know that's out there, that every single one of these shares will be hedged. That's not how market makers do that. They'll hedge them as they would a typical option. And the higher it goes, the more it'll be hedged up until that cap limit. The other piece with that is, if for some reason they're not hedged, then they need to go out and buy those calls on the existing market. So that won't be diluted. I thought that the 30% was for SoFi to begin to redeem those. And I believe it was 2 years before the expiry. But I could be wrong on that. Now, the piece that I'm most that I got the opposite idea from. So the cap is the net benefit for SoFi. So I understood these as functioning similar to vertical spreads, so that up until they hit that certain threshold, nine something, there's not really any tangible benefit for SoFi for this. But the max benefit that they actually have is the 14, whatever was double
14.45.
Yeah, thank you very much. What the double the price, and we can talk about that price action. I think there was something a little bit sneaky and nefarious going on with that. But so basically, if SoFi is at $25 a share at that point when they're looking to redeem these, SoFi, it's kind of like insurance, that they have these call options that they have, which will cover them up to that certain price, and then SoFi will have to pay the difference.
They're exposed afterwards.
Pardon?
They're exposed in terms of dilution, if I'm correct. After
if it goes
14.
above that,
or they can use cash. But either way,
and in today's filing, it actually said that they bought a number of cap calls that was the same number as the number of shares that they have to deliver. So that was actually in today's call, and they also disclosed that the strike price of the calls is $9.54, which is the bottom price at which the shares can be converted into, or sorry, the debt can be converted into shares, and then the cap, which is the top, is for that 14.45 that we've been talking about. So basically, between the share price, between where it is right now, we'll call it 70, whatever it was that it closed out today. Between there and 9.45, if SoFi stays until 2029 under that $9.45, right, they're unable to convert they wouldn't want to convert them because they'd rather have their debt back rather than have shares, and they're unable to convert them. And so something similar to what just happened now might happen again in 3 or 4 years when they have to they're getting close to this point,
right,
and they have to refinance, and they have to somehow come up with $750 million of equity, or of money to pay back to the debt holders, right? That's what ended up happening. So we wouldn't be having this conversation about the $61 million that are being diluted to pay back the old shares if the stock today was sitting at $40 a share, because they would have converted long ago. They would have had their shares, they would have gotten their return, and they would have been happy with that deal. And so, but the capped call is also in structured in such a way that if the stock price goes beyond this 14.45, then SoFi's upside is limited at that point. And then if it goes past there, there's a possibility that if they don't hedge or do something else past there, you start to get dilution again. Mm-hmm. And so it's it's a complicated, I understand options pretty well, right? But all the complex derivatives and hedges and other things that market makers do, and the way that they delta hedge and everything, this is something that I'm still learning about, and I'm certainly not an expert. And I've learned a ton this week, just because of this transaction, right? It's forced me to learn a bunch because I just wanted to know. And because SoFi is my biggest holding, and so I want to understand what's going on, so I understand what happens fundamentally to the company and what happens. So the idea is, up until 14.45, we're covered from a pretty decent amount of the dilution, as long as we're above, if we're in the range between, call it $12 and $14. And I guess the other thing that came out in the filing today is that the convertible note holders can choose to convert anytime that the stock is above 130% of 954, so that 12.28, right? So basically, if the stock gets to 12.30 and it's there for 30 days, they can convert anytime they want to after that.
In which case,
but SoFi in that case would have all these capped calls. They would immediately be able to exercise them, deliver the shares, say, here you go. And there's very little to no dilution for us. For us shareholders, right? I'm assuming everybody here is a shareholder. Otherwise, why would you be watching SoFi Weekly? And so
potential buyer.
Like that's the good scenario. Now, the thing is that like, personally, I'm not, let's say the stock goes to $25 by 2026. Am I going to be really mad that that's going to lead to 20 or $30 million or 30 million shares worth of dilution? No, because the stock is going to be at $25 and I am buying it today at $7, right? So if I have a 3 or 4 bagger, I'm not going to be, it's the same way, like the way that I think about this is the same way that like Elon Musk, in order for him to get any of his PSUs, the stock price of Tesla had to double. So in order for us to get to the point at which we're worried about higher dilution, the stock has to double. And that's not really a bad outcome for shareholders, right? And so, but, and it is complex, and you can, pull up a bunch of spreadsheets and say, hey, if we get to, $45 a share, then SoFi has to dilute us by 95. It's like, it's like 80 or 90 million shares. But if the stock is at 45 million or $45 a share, I don't care, because I would care if I was buying at 45 and then got the rug pulled out underneath me because I wasn't paying attention or whatever. But if I'm a holder right now, I'm not that worried about dilution. So I am frustrated by the $61 million in dilution to pay off the 600 million. There is a potential. So basically the way this works is if you're under 940, or if you're under 954, there's a chance for dilution. If you're above 1445, there's a chance for dilution. And in between there, SoFi is pretty well hedged so that we don't get very much dilution as shareholders when these come due and get converted. But if it's above that number, I'm not that worried about it. And there's a possibility at that point that they could take on other hedges. So the way capped calls work is a little bit different from covered calls. So most people are kind of familiar with covered calls, which means like if the strike price goes, or if the share price goes beyond some certain level, you have to give the shares to the person who bought the calls. A capped call is very similar in nature in the way that it's structured, but the difference between a covered call and a capped call is a capped call automatically executes at the price. So if the price gets to 1445, it's 54 and 45, and I keep getting them mixed up. I can't remember.
1454 is what I think it is.
Okay. Anyway, 14, whatever it is, we'll call it 1450. We'll split the difference. Right? If it gets to that price, they will automatically execute the shares, and then also the shares will be called away, basically, and so they'll get the money from the underlying. But then I don't know if at that point, like if they want to cover for dilution, they might be able to enter into other capped calls. They might be able to, SoFi might be able to take some other derivative position in order to cover for future. I don't know those details, right? That's all speculation at this point. But big picture, again, we're in the trees. If you want to take a look, if you want to look at the forest is any price up and between, call it $10 and $14, there's very little dilution for shareholders. Anything above $14.50, there will be some dilution, but that's okay with me because that means the stock will have appreciated by a pretty decent amount. That's my take anyway.
Going back to the reason for this, I had a thought. This kind of puts the pain point out to a further date. Do you think it entered into consideration the PSUs that Noto, Lapointe, and White are getting in 2026?
Yes. I mean, I'm sure they're thinking, I'm sure management's thinking about it. They're very aware of what those shares mean to them, right? And if they do, like if shares do go up to 25, it would mean a decent amount of dilution from these convertible notes. But again, I'm fine with that because it means the stock's tripled.
Is there any reason why these note holders wouldn't convert at the earliest time versus waiting till $25?
I mean, I guess the incentives are there. I guess if I was a note holder, right? I don't see. I don't know what the incentives are, right? Like I'm trying to think from their perspective.
Unless
would I want to convert at the
1.25%?
Yeah, you're not really holding for the interest. You could convert right then, as soon as it happens, and they have the option according to the contract to convert whenever they want to. But like, it's kind of like a call option, right? It's basically a call option for them. These notes is they're a long dated 2029 call option that they can execute at 9:54, right? Like if I could pay for, if I could enter into this transaction, I would love to. And so it's the same way where if you have a call that's long dated and it goes in the money by a pretty decent amount, and you're convinced that it might go further, right? You might want to wait to convert.
Well,
And so there is, go ahead.
So the note hold, there is the, if you, in the terms, like SoFi can redeem at any time until March 2027 when it crosses 1228, but the note holders can only convert on certain circumstances until September 15th, 2028. And so essentially, let's say the note holders can only convert once a quarter or twice a year or whatever. So if I can just buy back all of those notes if they have the cash on hand, if the stock is trading at 13 or 14. So note holders would be incentivized to essentially convert at their earliest convenience, because there's always a chance that SoFi can just buy back the notes.
That's a really good point. And so that is in the contract that by 2027, so basically 3 years from now, SoFi has the opportunity to pay these off with cash for the principal plus interest, is how the contract is written. My understanding of that is it's just for the 750 million. And so it seems like it's a little bit of a poison pill that they've inserted into the contract, where if the stock is trading at $13, $14 and you're getting up to that point, that, it's 2027, they would want to convert at that point, because they'd rather have shares that are worth, or shares that they're buying or that are being delivered at a price of $9.54, but are worth $14 on the open market, rather than having the chance that SoFi will pay them back with cash instead.
And I mean, these are pretty long dated debts, right? So SoFi right now, essentially, what made this stock move so much, at least in my opinion, is that the loan that they took out comparatively to just the overall size of the company is pretty large. I think it's like roughly, compared to the market cap at the time, was like 8-9% overall, especially now that they took the $112 million extra, oversubscribed it. But by 2027, 28, 29, whenever this starts to finalize, hopefully, if all goes well, dealing with these debts will be a much less of a problem, because it'll make up for such a smaller percentage of the company if they continue to compound at the rates that we're hoping. Yeah.
I guess one question that I had, because I think this was something that was more discussion was had around this, is where those shares are going to come from. So I've heard multiple different answers on this.
Mm-hmm.
And the one that I sort of subscribed to was that the brokers have to purchase the shares in blocks over the next, say, couple of months to get an average price, and so that they would take them off the market. They would essentially be part of the float, but non-tradable, held by the broker up until that point where that cap is hit, at which point they could have them there for SoFi to exercise the options. Or the other option is that the broker does nothing, and if and when that price is hit, at that point, the broker goes and buys the shares on the market. So I guess that's the part where I'm not sure, because the implication of that is this entire liquidity that's being sucked out of the total float, which could really spell trouble for shorts.
So this is the Uncle Bruce theory, we'll call it. Well, it's not really a theory, right? Uncle Bruce, who's another YouTuber, has had several videos this week. And if you want to get really excited about the convertible note offering, go listen to his videos. He has a lot more experience on Wall Street than any of us sitting on this podcast. So I think he probably knows what he's talking about. I've heard several
I'm going to give a little quick shout out, though, just to these three guys as well, who have also been extremely helpful during this. So yeah, thanks for great data-driven investing. This is Chris that literally is here. Go follow him. But yeah, and these three guys.
Go follow those other three guys, because they're very, very intelligent, and they've helped me understand this way better than I did a week ago. But I guess I've heard two theories, and I don't know which one's correct, because again, this is out of my realm of expertise. But there's the Uncle Bruce theory. I'll call them theories. I don't
UBT.
the UBT is that the people who sell these these capped calls to SoFi, they are obligated to deliver these shares in the event that the stock gets above that price, and so they are going to be gobbling up these shares in the open market, so that then they can give them to SoFi when SoFi is when the capped call gets exercised. And so what he says is that they will, they'll be buying, call it 80, 90 million shares on the open market over the next several months in order to cover their position. And that's possible. The other thing that I've heard is that it's possible also that these people who are doing these cap call transactions, all that they want, they're just going to be market makers, which means that they're providing liquidity for the capped calls, but they're not taking a bet one way or the other, whether SoFi stock goes up or down, or whether the company performs. And if that's the case, then they would delta hedge, which basically means that the calls that are being bought have some sort of delta. We'll call it 0.3. And so what that means for people who aren't as familiar with options is if the stock price of SoFi goes up by $1, the price of the call goes up by 30 cents. So that's what 0.3 means. It means you multiply the movement of the underlying stock by the delta, and that's how much the price of the option changes. And so what they would do if the delta were, say, 0.3, they would say, okay, we're going to have to deliver 90 million shares theoretically at some point in the future. We will go out and we will buy 0.3 times 90 million. So call it, 30 million shares in order to cover ourselves. And then as the stock price goes up, they would purchase more shares because the delta goes up as the stock price goes up. Or if the stock price goes down, they would be selling shares on the open market, and they'd just be acting as a market maker in that case. But that means if the stock price goes up, that means that they also have, there would be buying pressure from them because they would have to get more shares in order to cover their position. So I don't know, again, I don't know enough to know which is true or not, but in either case, there's going to be some buying pressure in the near term.
Exactly.
Is my understanding.
Yeah, I think it is the delta hedging, but I mean, I'm a novice here. I don't know for sure. But one key point with the delta, if people aren't familiar with options, it doesn't hit like 100% delta ever. And you have to be very deep in the money. So the price has to be well above that cap limit. So let's say 20, $22, something like that, before you're even at like a 0.95. So it takes a while. If it is delta hedging, they're not taking the full amount of shares that could possibly be exercised or called away.
Anything else on that part of this transaction?
Well, since we mentioned like squeeze, I don't think this is necessary for a squeeze. And I think the UBT is, at least the idea was in part that it was done for a squeeze. I don't think so. Uncle Bruce is used to GameStop, and yes, he's been around a lot longer than us, but Ryan Cohen's the CEO of that company. If Ryan Cohen switched places with Anthony Noto, I would believe it. I'd be like, yeah, that's a Ryan Cohen thing completely. I don't think Noto and team would do it for that reason. I do see credibility in them doing that so that they are able to, in part, to hit those performance goals, PSUs for 2026. I'm not invested for a squeeze. A squeeze might never happen. I wouldn't encourage people to invest banking on a squeeze. That can be very dangerous. You can be burned. Just re-roll the clock or watch Dumb Money, if you need to, as a reminder and refresher of like you can win big, you can lose big. But I'll also say that I'm not selling many covered calls just because there is that potential with this high short interest.
Yeah, so I have one more question on this because okay, so I get the whole like UBT versus the delta hedging strategy. Either way, there's going to be shares that are going to go off the market periodically from the broker to cover the call. Sure. And that alone may not cause a squeeze, but I think that can we all agree that institutions that took the other side of this deal that gave SoFi $862 million didn't do it for 1.25% interest a year? Like, what is their incentive? Obviously, they want to be owning the shares, correct? They are incentivized to convert. And if that is the baseline, which I think we all agree on that, if that's a baseline, can those same institutions just buy shares on the open market so as to drive the price up to their conversion, basically to ensure that they convert?
Yeah. So
I have no idea.
When's the earliest that they can convert if the price hits the 12.29 or whatever?
They have no time.
I believe July. It was in the contract today. I think it's in 2024. It's almost immediately.
Oh wow. Okay.
So anytime if it's above that, whatever it was, 12.27, for 20 trading days out of 30 days, including the last day of the month, it has to close above that price. It's all this confusingly worded lawyer talk. But if it gets above that price for call it a month, then they can convert. Starting this year.
Like if I were an institution and I'm, let's say, bullish on SoFi, let's say I'm Kathy Wood and I'm still buying anyways, and SoFi came to me and they said, hey, give me a loan, and what I'm going to do with that loan is I'm actually not going to dilute you as a shareholder, and I'm going to pay off some of my debts and actually help my bottom line, and you're still going to get the shares afterwards if the stock price hits a certain price by, let's say, July. If it hits $12, then I'm like, okay, here's the money as a loan, knowing that when it hits 12, I'll convert, and I'm incentivized to do that. And I'm just adding to my position behind the scenes. Like, let's say I'm Kathy Wood, I'm buying SoFi stock every single day, adding, because I know those shares are going to end up being mine anyways. And I'm incentivized to do this entire transaction to drive the stock price up, while at the same time, I'm giving money to the business to essentially help their cash flow, help their bottom line, help their balance sheet.
So I wanted to pivot a little bit. You brought up Kathy Wood. I think she bought somewhere over 5 million shares this week. Yeah. So completely reading into this, thinking this is a complete positive move. It absolutely is. Can I get from around the panel, who bought SoFi shares this week?
It's about 20% more SoFi.
Yeah? Awesome.
For me, It was heavy. For you guys, it'd be like, I don't know, a buy that you do in your sleep probably. But
I bought 1,000 shares this week. Not 20%.
I did a couple of options plays, one of which I posted on X. Another one I went into today. I didn't post it yet, but and then I did buy some shares too.
Yeah, I bought on 2 separate days, just shares. I've never bought anything other than shares. So, yeah.
You're probably better off for it.
Oh, it makes me sleep better at night. But whenever it comes to these, derivative markets, and then SoFi starts playing with them, I'm like, I'm in the law. Like, I got a lot of learning to do. So, but hey, that's where I really fall behind. Is I've always looked at SoFi as a complete, like, is this the best quality company that I could possibly buy? And then once it starts to get into, some of the technicals and the short interest and these sorts of things, that's when the reading has to start beginning, because it's not really what I focus on.
Yeah, I messaged Tevis earlier in the week, and I think it was like at 7:20 something at that point when we were messaging back and forth. And I was like, dude, if it gets into the 6s, I'm going to have to start selling things I really like. Not Palantir, don't worry, but other things that I really, really like.
We're not worried about Palantir.
So, yeah, we won't talk about that. It brings pain to Tevis. But he's like, there's no way it'll get to the 6s. And, I mean, it could have. It didn't. It's tough to push it down as much. And I think that it went down as much as it did on that initial day, just because the lower the price went, the better it is for these people that are offering this money for SoFi up here, that are part of this senior convertible note thing. So
we should talk about that really quick too, actually, before we sign off. So I don't usually subscribe to conspiracy theories and manipulation on the stock market. Like, I think a lot of that stuff is I don't buy into much of it. However, in this case,
analysts say a certain thing, but I do agree with you. Go ahead.
Anyway, and so like in this case, it makes a lot of sense, because and I wrote a Twitter post about this, but basically the idea is, if the lower the stock price goes, the more shares these people get when they convert. And so if you would have taken this exact same transaction and you would have priced the shares based on the closing price last Friday, which was $8.99, they would have gotten 24% less shares than since it closed at 8 or 7.27 or whatever it was on Tuesday. And so they're getting way more shares, first of all. So that's the first incentive, is number one, they get more shares of SoFi, because now their $750 million are being divided by, by 9, whatever it was, 945, instead of being divided by like 1170 or something. So they get more shares. And then the second reason, and I actually didn't put this in the tweet, but I should have, is now their conversion price is also way lower, right? So they can convert at it. So if it closed at $9, they would have had to get up towards $15 in order to convert their shares. Now it's only like $12. So they get, number one, more shares, and number two, a much higher likelihood of of that conversion price being hit. So there's two reasons that the institutions who now have $862 million on the line wanted the stock to go down. And it turns out that the stock had its worst day ever, which that's the part that was really nuts to me. Like, I understand there being news coming up, and the stock sells off 6-7% because people are confused about convertible notes. But like, I've been in this stock since it was IPOE. My first buy was like January or February of 2021, right? So I've been invested in this through the whole way. We had Upstart miss and drop 50% in a day, and SoFi stock was dropping with it. We had all this inflation news, 4 straight 75 basis point hikes. We had all this negative news. Never in all of those negative news
guidance
did we drop
revised down
15%. Yeah, the guidance and the student loan moratorium being extended over and over and over, and or SoFi having to drop their guidance because the student loan moratorium got extended. Like, you can count all these things that like fundamentally were really bad for the stock. And then you look at this news, which again, honestly, like, there's some bad parts, there's some dilution. We don't want to sugarcoat that. We tried to cover it, I think, pretty neutrally during this podcast, right? But there's also a lot of positive things that resulted from this news. So my personal opinion is that it's neutral at worst and probably slightly positive what happened this week. But then the stock dropped 15.3%, which is worse than any day in the entire history of the stock. That doesn't make sense to me.
Do you think, I got to be a bear. Tanner's a bear at least once a show. Do you think that is a fault of SoFi's for issuing such a large block of debt to, like, you're essentially incentivizing 8% nearly, like $800+ million of institutional money to try to manipulate this stock downward?
It was going to happen either way. It also happened for, like, Uber was massively down the day that they did exactly the same deal. Even though the deal was so over, I think they announced it at 1.2 billion, and they ended up oversubscribing, and it closed at 1.7 billion. Same thing with a capped call on top, and the stock took a big hit just because I think that, first of all, exactly what Chris said, these institutions are incentivized to get it as low as possible so as to capitalize on the deal. And then from a retail perspective, all these people read the headlines and they're like, what? They're issuing more debt? Oh no, dilution, this and that. And so, like, it's perceived negative until you actually read into the details. How many people did we have just this week alone that just didn't understand this? It took us so long to understand it and to see it as the positive news that it actually was, right? And so I think the gut impulse is to treat this as negative news. But look at what happened to Uber since November of 2023 when they did that deal. The stock has almost doubled after that. So
Rocket Lab did the same thing. So Rocket Lab recently had a convertible note, and they dropped like crazy on the day of as well.
Yeah, it's a very common thing right now just because of the credit conditions. It's very expensive to borrow. And so it's not just those 3 companies. I don't remember the other names, but there was a whole long list of very, very recent senior convertible notes. Same sort of deal with the covered cap. I said it wrong, but yeah.
Call.
Thank you. I was like, I got it backwards. So, no, it's happening. A lot of it's just the credit conditions the way it is. So I actually agree a bit with you, Tanner. Just, I don't know if there was a way that they could have. It's tough with like a blackout period of like what you could say, but it's a very complicated deal. I certainly didn't get it right away. I was like, okay, I know some of these pieces here, like lower interest, good, further out, good, dilution, bad. But beyond that, I'm like, all right, I need to dig in and do some research. And there's still pieces that are just kind of ambiguous in my mind. So I don't know if there would have been a way that they could have been a little bit more clear on what they were doing and why they were doing it. Maybe they were limited in that, but I would have liked to see that.
So I do think that. So, okay, here, I want to bring up this comment really quick. They said, Tanner, no, SoFi underestimated the share price effect. This is a tough investment lesson. You said no, and then said, yes, they didn't do it right. Like, but anyway, I think the Rocket Labs thing is a little bit different because they're a cash burning company that is acquiring debt. And I'm not anti Rocket Lab, but it's for survival. Every company needs cash. So, companies go bankrupt because they run out of cash. Simple as that. But what's it called? With SoFi, what came from a position of strength, at least, is that they didn't necessarily need this deal, right? They would have just survived on their own, and maybe growth would have slowed from a lending perspective. And then they used this as a potential way to continue to accelerate and lower expenses in certain areas. And so I do think it's more along the side of the Uber transaction versus Rocket Lab. But yeah, I'm positive on it. I just think that it was a large deal considering the size of the overall company. But this is something that Noto has done consistently. Like, even look at whenever they signed the SoFi Stadium deal. It was unheard of at the time for how small their company was back in like 2019 or whatever it was. So, he's a man that places big bets, and this is another one, and I'm absolutely loving it. But yeah,
regardless, I feel like cap call raises of this nature are going to become more prevalent at the moment that more companies start to do it, because I think it just makes sense, right? If you are operating from an assumption that these institutions want to be in the company anyways, then it incentivizes them to do so in a relatively risk-free way. They still have to get paid the money back if the stock doesn't hit that price. And they're incentivized to get the stock to that price, while at the same time funding the company, capitalizing the company to increase their operating leverage and better their balance sheet. Like, SoFi paid off debt with this, and they essentially made their EPS almost double overnight with this money that these institutions were going to get in anyways. And so it's like a win-win from both perspectives once those note holders convert. So I think it's going to become more of a more popular way that companies raise money.
I want to talk to you guys about a short-term trade that could possibly go off the back of this, but we're already past an hour, at an hour and 7 minutes. So why don't we pop over to the After Hours show? And if anyone wants to follow us there, obviously there's already a bunch of members here, but you guys can just hit the join button down below, or it's in the description that you can join the members, right? So
real quick, you guys should subscribe to Stock Market Nerd. His name is Brad Freeman, but he goes by Stock Market Nerd. He's going to be having an article that's coming out tomorrow where he breaks this down really, really well. He gave us a sneak peek of it. And you'll be able to, it's one thing to listen to us talk about it. It's much easier to be able to read it and reread the parts that are confusing or that you don't quite get. So go to his website, stockmarketnerd.com, right? And you can just, he will have this out in his weekly. So he does a weekly newsletter. I would say follow him anyway. Like, he's one of the best there is, in my opinion. Like, he gives really, really great analysis and news and everything else. But especially tomorrow's, if you're confused about this convertible note thing, make sure you go there tomorrow. He's going to post it, and it'll be well worth your time reading it.
Yeah, I absolutely agreed on that. Freeman is amazing. He just understands things quickly at a deep level. Real quick, there is in Tevis's channel, Uncle Bruce left a comment there. So don't know if you saw that, Tevis, but wanted to note that, and thank you for stopping by and for your video early in this week. That was helpful to understand a lot of these things, which are frankly above where I was at the time and still am, honestly. So appreciate that.
Brad's great. Guys, join, but we're going to head over to the After Hours show right now. Thank you so much. Bye for now.
Thank you.